when we spoke in April, you spoke about the fact that you expect the chain of COVID to break by December, and so you'll have a heading towards a normalcy in December, and then a normal Q4. We are in July, and we don't see that now it's breaking by September. So, do you still hold by that outlook of yours? And you also mentioned that the impact would be something similar to a GFC crisis. Do you now think that the impact could be a little more worse than the GFC crisis on a whole year basis for TCS? And my second question is on the TCV. We've been clocking a good level of TCV every quarter, but we're not able to get a conversion of those TCVs into revenues. What preventing those conversions now, and what percentage of the TCV which you had last year and now which you got are going in for renegotiation because of this COVID crisis? One question for Ramki is on the margin protection. I know fall in revenue is where impacts the margins drastically. But what kind of protection do we have even as you go for the next few quarters on the margin? Because this quarter you saw 150 bips fall in margin on a quarter-to-quarter basis.
Sajid, you were breaking, but I think the gist of your question. As I said, our visibility into Q3 is better now than what it was when we first spoke about it in Q4. And I gave you a industry-wise color on where that recovery trajectory looks like. But in summary, we should be breaking at year-on-year positive in Q3 in INR terms, and getting close to it from constant currency terms, and probably breaking even on a year-on-year basis in constant currency by Q4. So if you compare that with GFC, it is again similar to what we had said, that the impact is steepest in Q1, and we should then see a recovery. If our current expectations play out, the recovery trajectory from here will be higher than or faster than the recovery trajectory that we had post the GFC. And that's primarily because the response to the crisis by various governments and institutions has been extremely coordinated and very large and very early, and that deployment has happened, and that should play out, and we should see the benefit of it coming. So this is the environment that we currently see, and we will keep updating it as we go through the rest of the year. From a pipeline perspective, I think the best way to think about the pipeline and understand it is in terms of market share gains. We have been steadily gaining market share in all the key markets that we operate in, and that is the true sense of what that pipeline is indicating, because that pipeline is about the incremental business out there and our greater relevance and our greater ability to satisfy the emerging needs of our customers. So overall, the pipeline trend is very, very positive. Both it shows demand for our services as well as it shows our competitiveness and our ability to engage with our customer set. I'm very happy with that.
Just as when there was a contraction, there is an impact on margins. We believe that with the growth recovery, there will be improvement in the margins as well. So you just heard Rajesh saying about how we expect it to come back by Q3 and Q4. So I think from a margin perspective, that improvement will also be in that line. Some of the discretionary spend, which we'll continue to exercise the whatever measures we have been trying to do, but some we will have to be released. But I think we'll have to bake all this into your estimation of how it will go forward. So the key is the recovery in the growth.